Welcome to the Market Mosaic, where every week we are looking at macroeconomic data, stock market technicals, and market internals, things like breadth and sentiment. We're looking at the intersection of all these variables to try to figure out what the near and intermediate term outlook for the stock market looks like. Now for this week, it's all about the Fed. So we've got the last Fed rate setting meeting for the year, and expectations are running high that we're going to get a third consecutive rate cut, which is absolutely incredible when you consider the inflation and economic growth backdrop. Now I'm going to explain that here really quick. So we received just last week the delayed September personal consumption expenditures price index. This is the PCE index. This is the Fed's preferred inflation gauge, and it showed a headline increase of 2.8% in September. So the dark blue line on here is that year-over-year headline increase in the PCE. And you can look at how this is evolving over shorter term time frames too. If you annualize what this is doing over a 3-month period, what it's doing annualized over the past 6 months, I try to look at different time frames in the trend of PCE inflation. Now the core PCE increased by 2.8% as well. Core figure strips out food and energy, and the market's breathing a little bit of a sigh of relief with this figure because it was in line with economist estimates. But here's the thing: the headline figure has accelerated for 5 months in a row. So you can see that trend right here. So for 5 months in a row, you have seen the headline figure accelerating on the year-over-year gain, and it remains above the Fed's 2% inflation target. That's the yellow line across the horizontal axis here. This is the Fed's 2% inflation target. The last time PCE was below the Fed's inflation target was way back here in February 2021. All right, now, at the same time inflation remains well above target, there is more evidence that the labor market and the economy are not deteriorating as once feared. There's a lot of fear over what was happening with the consumer business surveys as a trade war kicked up, and I'll have some more on that data here in just a second. But you look last week and we had initial jobless claims falling to a 3-year low during Thanksgiving week. Now jobless claims, in my opinion, are one of the best, if not the best, higher frequency look at how the labor market is evolving. And it doesn't stop there. We had S&P Global, their U.S. composite PMI for the month of November. It came in at 54.2. Now the way these PMIs are constructed, a reading above 50 points to expansion, below 50 shows contraction. So at 54.2, that remains in expansionary territory. That is consistent with growing GDP. And so again, here we come back to the Fed again. Inflation is above target. The economy is holding up fine. You have the S&P 500 near all-time highs, and yet the Fed looks set to cut rates for a third consecutive meeting. If you look at market implied odds, there is an 86% chance of another quarter point cut next week. And now here's the thing. I don't think they should be cutting right here. But at the same time, I cannot imagine more bullish conditions to help drive the stock market than to be getting rate cuts at a time when financial conditions are already loose. The economy showing signs of growth. That is good for the earnings outlook. And so we'll take this while we can get it, because I don't think it's going to last for long. I think growing economy and inflationary pressures will eventually force the Fed's hand in the other direction. But we're not there just yet. So, I want to look at some evidence that consumer spending fears that are showing up in surveys are not being reflected in hard economic data. We continue to see that. That's good for the outlook for earnings. And another positive that's going really overlooked right here is how certain stock market sectors are evolving, sectors that are cyclical and sensitive to economic activity. So we'll take a look at that. And then I want to come back to inflation at the end and talk about one of the things we need to keep an eye on for 2026, and that is if we're going to get another inflation wave. All right, so since the trade war erupted during the first quarter of the year, there's been a very sharp divergence between soft data. So the soft data, the blue line on this chart, is things like consumer and business surveys. So, asking people how they feel or what the outlook is. We're seeing a big divergence from how the hard data, how the economy is actually performing. So that's what the chart on here does. It plots It indexes hard data and soft data, economic surprises since the start of the year, so indexed to 0, and how these have evolved during the year. So you can see a pretty tight correlation until you get to about late March, early April. That's when the trade war headlines were out in full force, and you see the deterioration in the soft data, again, mostly a lot of like survey-based things. Meanwhile, how economic data was actually coming in has been surpassing expectations. And so, all these negative attitudes, negative views toward the economy and the outlook, it has not been showing up in the hard data. So, that's really important with consumer spending and retail sales, especially, given how much of the economy that makes up. And right now we have the Atlanta Fed's GDP Now model pointing to 3.5% annualized growth. So again, the hard data is painting a much more positive picture, which is very important because this is how the economy is actually performing versus views coming from the soft data. We had the most recently completed earnings season also echoing positive trends that we're seeing in economic data. So if you look at with the third quarter reporting season pretty much wrapped up for companies in the S&P 500, 83% of companies beat earnings estimates, while 76% beat their revenue estimates. Both the beats on both the top and the bottom line are well ahead of the 5-year average of what you tend to see. And here's the thing, these positive financial results are being reflected in the outlook. So this chart shows the percent of S&P 500 companies that are raising their earnings guidance. And you can see, again, going back to really the start of the year, you start to see this figure accelerating despite what you had happening with the trade war and uncertainties on the economy. What was happening, at least what companies were seeing within their own respective end markets, within their own respective businesses, you had a growing percentage of companies raising estimates. And so, this figure now stands at the highest level we've seen since 2021. If you look at earnings growth right now for 2026, again, this is collectively for the S&P 500, earnings growth is expected to increase by 14.5%. Revenues are expected to increase by 7.1%, again, just for the companies in the S&P 500. And we've seen this overall positive trend continuing of companies raising their earnings guidance. So the message coming from various sectors of the capital markets, I believe, is confirming the positive outlook for the economy and earnings. So I've recently analyzed price action and the bullish setup that we have in LME copper prices. So the London Metals Exchange, that's a better global benchmark than using US prices for copper. And if you look at the LME contract, copper is building on a breakout from a bullish ascending triangle pattern that's been created over several years. And because of that, you have copper miners rallying as well. They call copper Dr. Copper because it has its PhD in economics, so to speak. They're just reflecting that it's very sensitive to developments with the economy. But here's the thing, other cyclical sectors and stocks are echoing that same outlook. So we've talked about Caterpillar in the past. Pull up a chart of CAT and you'll see a pretty sharp rally going. And now you're seeing transportation stocks breaking out as well. So that's what this chart on here shows. It shows the IYT ETF that tracks the transportation sector. So again, why would we want to watch this? Well, because those companies like railroads, trucking companies, even airlines that are moving freight are going to be sensitive to volumes, which is impacted by economic activity. And you can see this is a weekly chart that goes back several years for IYT. We had this, the pullback and with the rest of the market selling off into the trade war, a rebound. This is tight sideways trading action since June, and now we're seeing a breakout to new highs. All right, with the Fed's final rate setting meeting of 2025 happening here this week, the outlook for rate cuts has become a very key driver for stock prices. So the pullback in the S&P 500 from late October into November happened alongside falling odds for another rate cut this month. In recent comments, key Fed officials, that helped drive odds back the other way. So odds began favoring a rate cut again, which also sparked a recovery in the stock market. So if you line these things up, you'll see that shifting odds for rate cuts coincided with the pullback and then subsequent recovery that we saw. in the stock market. But the thing is that the recovery recently, we had a sharp rally start to develop as we headed into Thanksgiving week here in the U.S. The recovery's been very strong in the average stocks. We've had really strong breadth with mid and small caps having a really sharp rebound. So the performance of small and mid caps are especially sensitive to what the Fed's doing on interest rates. So that's what this chart on here shows. This chart compares the forward returns over multiple time frames, so over 3 months out, 6 months out, and 12 months out from when the Fed starts cutting rates. And you can see small caps over all time frames outperforming mid caps over all time frames, which outperforms large caps over all time frames. So smalls and mids outperforming larges when the Fed's cutting. Smalls doing the best out of all three capitalization ranges. And so when we've seen, again, if you look at the rally that has developed since heading into Thanksgiving, smalls and mids have been doing very well, which reflects that the catalyst behind the rally has been that expectation for more rate cuts. Hopes are running high that the Fed will deliver a third consecutive cut, but that risks adding further pressure to inflation at a time when the economy is already performing much better than expected. Financial conditions are already much looser than average, and you're seeing market sectors that are sensitive to high and rising inflation are moving higher. This is, in my opinion, this is the stock market's way of telling you that there are some inflation fears really growing out there. Gold miners are sensitive to inflation. Copper prices have a high correlation to inflation, and so that's a concerning trend. And here's the thing: various measures of headline consumer inflation have been accelerating in recent months. This could be the start of a major inflection point if we keep tracking history. And so what the chart on here shows is it takes the consumer price index, the CPI, and it shows the green line is how CPI has evolved since 2014. This blue line on here overlays it with the what CPI did during the stagflationary period around the 1970s. And so you can see we had, starting in 2020, coming off the pandemic, the green line, we had one big inflation wave and then a trend of disinflation. This has tracked what we saw in the early to mid 1970s really well. Now, if we continue to track this cycle, where we are at the green line right now, within the next few months, or as we head into 2026, if this keeps tracking, you would expect to see a new wave of inflation start to hit. So keep, I'm not saying that this has to happen based on this chart alone, but again, when you look at the conditions that are out there, again, you've got the Fed is cutting rates into financial conditions that are already loose with an economy that's already showing strength. You are receiving warnings from market sectors that are sensitive to inflation. So I think that makes this chart very compelling right here, and one that we really need to pay attention to. Here's another interesting way to look at how the AI trade, so artificial intelligence, is impacting companies. We know AI has been probably the most significant catalyst behind the bull market that started back in October 2022. We know the Mag 7 has been a huge driver of gains in the S&P 500 since then, and that many, if not all, of the members of the Mag 7 are in some way, shape, or form leveraged to the AI trade. Well, we know companies that are geared toward the AI trade have done very well, and this is just another way to look at that and break this down. So what this comes from FactSet, what this does is it looks at S&P 500 companies that are citing AI during their third quarter earnings calls, and how those stocks, how their prices have evolved, the price change, the performance of their stocks over certain look-back periods compared to companies not citing AI on their calls. And I find this very, very interesting. If you go back to the start of the year, so basically year to date, companies that are citing AI on their third quarter calls, they have seen their stocks go up about 14% on average during the year. Companies that are not citing AI on their call has seen a gain of but 5.7%. So companies mentioning AI significantly outpacing by more than double companies that aren't mentioning AI. You're seeing it over a shorter term time frame as well. So since June 30th, how that looks. And really short term since the fourth quarter began. So just another way of breaking down and quantifying the impact of companies that are mentioning AI on their calls as they leverage that trend. All right, economic data for this week. The only thing that is going to matter is on Wednesday when the Fed concludes their meeting. And so a couple things that I would look for out of this. Number one is, yes, the market currently expects the Fed to cut rates by another quarter point. That looks locked in. The thing to watch out for is if we get what you would call a hawkish cut. So what that basically would mean is that the Fed cuts, but in the economic projections, if you see estimates for inflation being kicked up, or you could also maybe see estimates for overall economic growth revised higher, if you start to see estimates around labor market data, being revised higher, not looking as bad as initially expected. So those would be things to watch for, and then absolutely listen to what Powell is saying during his press conference. If he comes out and comes out and along the lines of calling this another risk management cut, and look from there to see how he's trying to steer the outlook for more rate cuts. In my opinion, they really don't need to be cutting rates right here at all, but looks like they will based on market odds. And we'll see if during the press conference, Powell tries to shut the door on further cuts from here. One stock to keep an eye on this week. So we talked about companies mentioning AI and how their stock prices have been outperforming this year. One of my favorite trades linked to the AI theme, or potential setups to trade linked to the AI theme, is with ticker GEV, GE Vernova. So this company is leveraged to the AI build out via power demand. So think of it as a pick and shovels play on the AI demand for energy to run all these AI applications and via data centers. And so what I want to watch for with GEV is this initial peak around the 675 level in the stock back in July. We've been creating a very constructive basing pattern since then. So overall, a relatively tight trading range. We had a bit of a larger pullback into November, but look, we've stabilized and we're coming right back up to the prior high. So what I would really like to see with this setup is one more test of the 675 level. We get a smaller pullback off there, ideally probably something that holds above 600, and then we look for the breakout. The fundamental story behind this name is really strong when you're looking at the sales and earnings growth. And if we get a breakout, I want to look for higher volume on the breakout. You can visualize that with the standard deviation indicator. And I want to see this RS line at new highs as well, confirming that move. All right, that is all for this week. Good luck trading in the week ahead.